Portions of this podcast use AI-generated voices and AI-assisted analysis for commentary and entertainment purposes.
So if I asked you to picture a defense contractor, one that's securing national security frameworks for the Swedish government and clearing volatile minefields in Eastern Europe, you're probably picturing a massive corporate campus.
Oh, absolutely. Like you imagine thousands of employees, these huge assembly lines.
Yeah, exactly. A military industrial complex that basically looks like a small city.
Right.
But today's source material, it actually reveals a publicly traded company doing exactly all of that with a grand total of, wait for it, 40 people.
Yeah, it really just shatters that conventional image completely.
It does.
Because, we always see these geopolitical headlines about billions in defense spending, but we rarely get to see the actual ground-level mechanics of the businesses fulfilling those needs.
Right, the actual day-to-day operations.
Exactly. And today we've got the newly released May 2026 QON interim report for Argo Defense Group.
And for you listening, whether you're analyzing new investment landscapes, maybe prepping for a strategy meeting, or honestly just fascinated by the hidden machinery of the modern defense sector, this deep dive is just an absolute masterclass.
It really is. We're taking this incredibly dense financial document and extracting the core strategy.
Yeah, showing you exactly how a company navigates such a highly regulated, high-stakes market. So, okay, let's unpack this, because before we can even look at the financials, we really have to understand how a 40-person operation even functions at this level.
Well, the structure is really the secret here. The report notes that Argo was officially formed as a group in 2025.
Okay.
But the actual businesses, the 6 subsidiaries that make up the group, their operational roots, go all the way back to 1958.
Yeah, so they've been around a long time.
Yeah, so it's a classic textbook roll-up strategy. I mean, you create this new corporate umbrella to unite several battle-tested legacy companies.
Oh, I see. So you gain the agility and, the access to capital of a newly listed public entity.
Right, but you keep the deep industry experience of these businesses that have been navigating public procurements for literal decades.
That makes sense.
Yeah.
But 40 employees across the
It's
entire group.
Yeah.
That's the detail I just keep tripping over. I mean, they're spread across 6 different locations.
Yeah, Stockholm, Gothenburg, Jönköping, Kumla, Fugesta, and an office in Kyiv.
Right. And they operate in 3 distinctly different business areas. You've got defense material, counter-explosive risk solutions, and airfield operations.
Mm-hmm.
With that kind of footprint, I have to assume they aren't actually, building the hardware themselves. Are they essentially just a hyper-specialized middleman, just passing paper between the government and the factories?
Oh, no, far from just passing paper. Think of them less as a giant hospital full of general orderlies and more like a highly elite surgical team.
Okay, surgical team.
Yeah, because their entire business model is built around participating in these complex public procurements. And the barrier to entry there is extreme technical knowledge, not just raw manpower. I mean, they design the specifications.
So they're the ones figuring out what actually needs to be built.
Exactly. They manage the integration of highly classified technology, and they oversee the ultimate deployment of it all.
Oh, wow.
Yeah. So they might outsource the actual bending of sheet metal to a trusted vendor, sure, but Argo is the one holding all the intellectual property and the project management expertise.
So they're the architects, not the bricklayers.
Precisely.
Okay, that makes the financial engine we're seeing in this Q1 report so much easier to comprehend. And Q1 2026, that's a massive milestone for them, right?
Oh, huge. This is their first fully reported quarter as an actually listed company.
Because before this, they were just using pro forma numbers.
Right. Previous reports used that pro forma accounting method, which is basically asking, if these 6 distinct companies had been a single group last year, what would the financials look like?
Just hypothetical.
Yeah, exactly. But this report, it finally gives us actual consolidated data. And the story here is really one of highly profitable, deliberate growth.
Yeah, let's look at those numbers. Net sales for the quarter came in at 45.6 million Swedish krona, or MSEK.
Yeah.
And I'm looking at their EBITDA, that's earnings before interest, taxes, depreciation, and amortization, and that's sat at 10.2 MSEK.
Which gives them an EBITDA margin of 22.2%.
That's incredibly high, isn't it?
It's massive. I mean, in a sector that deals with physical infrastructure and heavy hardware, maintaining a margin north of 20% really proves that surgical team analogy.
Right, because they aren't engaging in some, race to the bottom on price.
Exactly. They charge a premium because they provide these niche, advanced solutions that very few competitors can actually deliver.
So digging into the breakdown of those numbers, one division is clearly doing the heavy lifting here.
Oh, definitely. The defense material area.
Yeah, driven by their subsidiary Swedish Net Air and Defense. They accounted for 41.1 MSEK of that total revenue.
And that specific division operates at an even higher EBITDA margin, 29.3%.
Wow. And a massive catalyst for that revenue was this second call-off order they received from the Swedish Defense Material Administration, the FMV.
Right.
It was a 54 MSEK order for these specially adapted containers, which are scheduled for delivery later in 2026.
Yeah. And because of major moves like that, their overall order intake for the quarter just shot up by 207% actually to 90.3 MSEK.
That's unbelievable. And their backlog grew by 168% to 144.4 MSEK.
It's a huge jump.
But wait, for you listening, let's try to ground this in reality for a second.
Yeah.
Because a 168% jump in backlog sounds incredible on a slide deck. But how does a 40-person team physically execute a 54 million krona container order without, completely burning out or snapping their supply chain?
Well, it comes right back to that architect model we talked about.
Right.
When you receive a massive order for specially adapted military containers, you don't suddenly go out and hire 100 welders.
You'd go bankrupt trying to scale up that fast.
Exactly.
Yeah.
You leverage your existing vetted network of subcontractors. Argo's 40 employees, they are busy ensuring that the electromagnetic shielding inside those containers actually meets classified military specifications.
Oh, so they're doing the highly specialized classified work.
Right, and they're coordinating the logistics. The heavy lifting is scaled through those vendor relationships, and that is what allows the core team to remain small, agile, and highly profitable.
That makes total sense. And it leads perfectly into this concept of framework agreements that is mentioned everywhere throughout the report.
Yes, framework agreements are crucial here.
The financial state Argo has 867 MSEK in ongoing framework agreements, and they have 583 MSEK still remaining to be called off. Is the modern defense industry basically operating on like a corporate subscription model?
Well, it's similar, but let's upgrade that analogy to, say, a municipal power grid.
Okay, a power grid. I like that.
So a framework agreement is this overarching multi-year contract. It establishes all the really complex terms, the pricing, the technical specs between a defense agency and a contractor.
Right.
So the agency essentially builds the power grid by signing that framework, but they don't pay the full value on day one.
They only pay when they flip the switch.
Precisely. When the military actually needs the equipment, they issue what's known as a call-off order against that framework.
Oh.
And this gives the government the flexibility to scale their purchases based on real-time geopolitical needs. But for Argo, it provides this incredibly robust, predictable revenue base.
Because recessions don't typically cancel national security framework agreements.
Exactly. They are highly insulated from normal economic cycles.
Which really explains CEO Marcus Selmy's tone in his commentary. He stated, and I'm quoting here, "We are delivering according to plan, and our outlook for the full year remains unchanged."
Yeah, that's confidence.
Right. When you have 583 million krona in, like potential energy just waiting in the grid, you can plan your corporate strategy with a level of certainty that commercial retail businesses can really only dream of.
Oh, for sure. However, a balance sheet is rarely just a straight line heading upward.
That is very true.
You know, reading a financial report requires understanding operational context. Otherwise, natural business cycles can sometimes look like massive red flags.
Yeah, let's talk about that. Let's look at the Airfield Operations Division, specifically the subsidiary LPG Traffic Marking Agar.
Right.
In Q1, they reported a negative EBITDA of 1.5 MSEK. And if you're just skimming the numbers, seeing a division operating at a loss is usually cause for concern.
It is, but the market understands that this is just natural seasonality. LPG Traffic Marker Ingar repairs airfields and they paint traffic markings.
Right.
You physically cannot paint a runway in Sweden during January or February. I mean, it's buried under ice and snow.
So the report is essentially treating Q1 as like a staging phase.
Exactly. They are actively choosing to eat those costs in the first quarter.
Ah, okay.
They use that downtime to perform maintenance on their specialized equipment, negotiate raw material prices, and basically stage their logistics. So the moment the spring thaw arrives in Q2 and Q3,
They can just immediately execute their planned projects.
yes, the negative margin there is simply a cost of doing business in a Nordic winter.
Got it. But there is a much more significant negative number on the cash flow statement that we really need to address here.
Let's hear it.
Their overall cash flow for the period dropped to negative 25.9 MSEK. I mean, I'm looking at a company that just hit a major milestone. They have incredible margins, and suddenly they are nearly $26 million in the red on cash flow.
Yeah, but you have to look down at the investing activities line item. This was not some sort of operational bleed. It was a highly targeted strategic acquisition.
Oh, the Poseidon deal.
Exactly. On March 2nd, 2026, Argo finalized the acquisition of 99.55% of Poseidon Diving Group AB, and then they grabbed the remaining fraction in Q2.
And that move cost them 44.6 MSEK. So that negative cash flow is actually just a strategic shopping spree.
Right.
But honestly, I'm struggling to connect the dots here. Why is a company that manages, airfield markings and specialized military containers buying a diving company?
Well, Poseidon does not manufacture recreational snorkels. They develop highly advanced closed-circuit diving and breathing equipment, and it's engineered specifically for military units, rescue teams, and professional users worldwide.
Okay, so how does that fold into Argo's ecosystem, though?
Well, look at their second business area, counter-explosive risk solutions. By acquiring Poseidon, Argo is basically taking this deep expertise in underwater life support systems and fusing it with their existing explosive clearance operations.
Oh, wow. So it expands their capability from just land-based demining to full underwater threat management.
Exactly. Things like neutralizing ordnance in critical harbor infrastructure or protecting offshore energy assets.
So it basically expands the surgical team's toolkit into an entirely new environment.
Yes. And financially, it is an absolute masterstroke in acquiring intellectual property.
How so?
Well, the balance sheet details a fair value adjustment of over 15 million SEK that is dedicated solely to Poseidon's brand-related intangible assets. So Argo isn't just buying a factory or an assembly line, they are buying the underlying proprietary technology.
Oh, I see.
And when you own the IP, your overarching framework agreements instantly become way more valuable because you aren't paying licensing fees to some third party. It is a textbook value accretive acquisition.
That makes a lot of sense. But owning that cutting-edge IP is pretty much useless if you can't deploy it where the acute need actually is.
Very true.
And right now, obviously, the most demanding testing ground for unexploded ordnance management isn't some controlled lab in Sweden. It is on the ground in Ukraine.
Yeah, which brings us to the operational reality of their subsidiary Disarmament Solutions Ukraine. They have established a permanent management function that is physically located right there in Kyiv.
Yeah, and I'm looking at the build-up costs associated with this Kyiv office in the report, and I have to admit, I'm a bit stuck on this.
Why is that?
Well, from a pure spreadsheet perspective, taking on the massive overhead, the security logistics, and the insurance of maintaining a permanent office in an active conflict zone, it just seems like an unnecessary financial risk.
Right.
Why not just export the equipment from the safety of Stockholm? Is there really a functional operational reason they must maintain a physical footprint there?
Well, you simply cannot manage complex life-or-death logistics remotely with the kind of speed required in a dynamic environment like that.
So it's about agility.
Absolutely. The report explicitly highlights that this physical presence provides direct access to a region with severe security needs. It shortens the decision-making loop drastically.
Oh, so they aren't waiting on emails and approvals from 1,000 miles away.
Exactly. By having project managers actually on the ground, Argo intimately understands the real-time conditions of the soil, the specific types of ordnance being encountered, and, the immediate supply chain bottlenecks. They can tailor their solutions on the fly rather than just guessing.
But I assume operating in that environment means their sole client is the military, which, again, from a business risk perspective, feels precarious. I mean, if defense budgets shift or if the conflict eventually enters a frozen state, doesn't their revenue completely dry up?
Well, that assumption actually ignores the broader reality of infrastructure recovery. Their client portfolio is remarkably diversified.
Oh, it is?
Yeah. I mean, yes, they work with the Ministry of Defense of Ukraine and the Swedish Armed Forces, but they are also executing contracts for massive global civil entities.
Like who?
Well, the United Nations Development Program, the UNDP, and the United Nations Office for Project Services, OPS.
Wow, okay.
They also partner with the Swedish Civil Defense and Resilience Agency, the MSB.
That civil defense angle is fascinating
Hmm.
because it's not just about active combat.
Exactly. Demining a field serves an immediate tactical military purpose, sure, but it is also a fundamental prerequisite for civil recovery.
Right, because a community literally cannot plant crops or rebuild a school or safely receive UN aid convoys until those explosive risks are neutralized.
Precisely. By servicing both acute military operations and long-term civil resilience projects, Argo essentially creates this deeply diversified revenue stream that outlasts any single phase of a conflict.
So if we zoom out and look at the entire blueprint we've analyzed today, Argo Defense Group is really proving that scaling a modern defense enterprise requires a completely different playbook than what we saw back in the 20th century.
It really does. It relies entirely on agility and precision.
It's about securing those multi-year framework agreements that act like a power grid of potential revenue.
Right.
It's about understanding the seasonal cadence of your subsidiaries so the market doesn't panic during a purely normal winter slowdown.
Right.
And it is about making these razor-sharp, cash-heavy acquisitions, like securing Poseidon's underwater IP so you own the technology rather than just brokering it.
You know, when you lay out the strategy like that, it actually introduces a genuinely fascinating vulnerability that the broader market rarely discusses.
Wait, where's the vulnerability? Honestly, it sounds completely airtight.
Think about the scale. If the future of national resilience and critical defense infrastructure is increasingly reliant on these niche, privately held microgroups, companies holding vital intellectual property but operating with only 40 employees, what happens to national security when one of these tiny companies is targeted?
Targeted how? Like a cyber attack?
Or a corporate acquisition. I mean, a massive defense conglomerate. Or worse, a shell company backed by a foreign adversary. They wouldn't need to bomb a factory to disrupt supply chains.
Oh, wow. They could just buy them out.
Exactly. They could simply launch a hostile takeover or an aggressive buyout of a 40-person company that holds the sole IP for critical underwater breathing apparatus or explosive clearance tech.
That is, wow. That entirely flips the narrative.
Doesn't it? How do governments protect their subscription to security when the companies holding the keys are small enough to just be bought out from under them?
The agility that makes a 40-person surgical team so effective and profitable also makes them a highly concentrated point of failure for the nations depending on them. That is definitely something for you to chew on as we watch this sector evolve, because the landscape of defense spending is far more nuanced, more strategic, and frankly, more fragile than just tracking billion-dollar budgets and sprawling factories. What everyone listening, thank you for joining us on this deep dive. Keep questioning the numbers behind the news, look for the framework agreements hidden in the headlines, and we will catch you next time.